Welcome back to Economic Briefing. Today we are talking about gold. Gold prices have reached record highs, hitting over $3,500 an ounce, while stock markets turmoil as a consequence of the US trade war. Gold is mined on all continents except Antarctica, with China, Russia and Australia leading global production. The current annual production is at around 3,300 tons. South Africa used to be the largest miner in the 60s and 70s, producing nearly 80% of the world's gold output alone, and at its peak 3 times as much as the current largest producer. Overall, levels of gold production have grown significantly in the past 2 decades, with many countries ramping up gold production, although substantial new discoveries are increasingly rare. As of today, around 80% of all known gold reserves have been mined. All of the above-ground gold would fit into a single cube of 22 cubic meters. Gold has a market capitalization of 22 trillion, which makes it bigger than any individual company. However, it remains a small asset class. For perspective, the market capitalization of the S&P 500 is twice as much at 44 trillion. The global stock market is valued at approximately 110 trillion. The bond and real estate markets are even bigger. Bitcoin, for comparison, has a market cap of 2 trillion. Nearly half of the world's gold is crafted into jewelry, while 22% sits in private investments, including bars, coins, and gold-backed ETFs. Another 17% are official reserves at the world's central banks. The United States have the world's largest gold reserve, followed by Germany, Italy, and France. In the recent years, mostly emerging countries have increased their gold reserves, whereas Western countries' reserves are mostly unchanged. Over the last 3 years, China, Turkey, Poland, and India were the countries that increased their gold reserves the most. You might be surprised to hear that the IMF has the world's 3rd largest gold holdings. Let us quickly dive into the gold mining process. Gold mining is a long process over many decades. There are 2 main types of gold mines: surface and underground mines. The size and shape of the ore body will determine which type of mine is constructed. Surface mining is used when the ore body is relatively shallow. The rock is removed layer by layer from the surface of the earth. This is less costly than underground mines as it does not require deep level excavation. If the surface ore is exhausted or the ore body extends deep into the earth, then mining goes underground. A complex network of tunnels and shafts is built to access and transport ore from deep underground. The mining process goes through different phases. The initial phase involves identifying potential gold deposits through geological surveys and testing. It is a high-risk stage, as less than 0.1% of explored sites lead to a productive mine. Once a viable deposit is found, companies plan and construct the mine and necessary infrastructure. This includes obtaining permits and building facilities to support operations and local communities. After that, the mining operation starts. During this phase, gold ore is extracted and processed into gold bars and coins. The economic viability of mining certain areas depends on factors like gold prices and extraction cost. Technological advancements are making operations more efficient and environmentally friendly. After mining ceases, efforts focus on dismantling facilities and rehabilitating the land. Companies are responsible for monitoring the site to ensure environmental stability. Long-term environmental monitoring and land restoration continue, often for 5 to 10 years or more, to ensure the area returns to a stable and safe condition again. Gold is a precious metal with strategic importance. Central banks hold gold to diversify foreign exchange reserves and mitigate dependence on any single currency, especially the US dollar. Gold's high liquidity and deep markets ensure central banks can deploy it quickly in times of severe stress, serving as both a collateral asset and a means of settlement when currency markets freeze. As geopolitical tensions and questions over reserve currency reliability intensify, gold remains a politically neutral asset, offering central banks a secure store of wealth immune to sanction risks or sovereign credit downgrades. For investors, gold is a safe haven asset in times of economic turmoil and a hedge against inflation, safeguarding purchasing power. Gold also has low or negative correlation with stocks and bonds during periods of market stress, enhancing portfolio diversification and reducing overall volatility. In many jurisdictions, gains on physical gold enjoy favorable tax treatment after certain holding periods, further increasing its appeal. Investors have 3 different ways to invest in gold. First, investors can buy physical gold, either bars or coins such as the South African Kruger Rand, Canadian Maple Leaf, or American Eagle. The beauty of physical gold lies in its direct connection to gold's spot price, offering a true hedge against inflation or economic turmoil without relying on anyone else's promise. You own a real asset untouched by counterparty risk. Physical gold also preserves anonymity. However, this comes at a cost. You will pay premiums, often 2 to 10% above the spot price, and face storage costs to keep the gold safe. Selling physical gold can also be less liquid. Therefore, physical gold is more appealing to long-term buy and hold investors. Next, let's turn to financial products, a broad category that lets you track gold prices without touching a single bar. This includes gold ETFs, which you can buy through your brokerage account and trade like stocks. There are also futures and options offering leveraged bets on gold's price, or gold-backed cryptocurrencies like Pax Gold, which let you own fractional gold digitally. The biggest advantage of financial products is liquidity. You can buy or sell ETFs or futures in seconds and costs are low. You avoid storage hassles entirely. But there's a catch. These products can carry counterparty risk. If an ETF issuer or digital platform fails, your investment could be at risk, although this risk is rather low with reputable providers. Finally, there are mining stocks, where you invest in companies that dig gold out of the ground, like Newman Corporation or Barrick Gold. These stocks offer a leverage play on gold prices. If gold rises 10%, a miner's profit might jump 20 to 30%, boosting stock prices. Some miners even pay dividends, adding income to your portfolio. This approach is accessible through any brokerage and can yield high returns in a gold bull market. However, mining stocks are volatile, tied not just to gold prices, but to operational headaches like labor strikes, rising energy costs, or mine failures. They also move with the broader stock market, which can dilute gold's diversification benefits. Poor management or geopolitical issues in mining regions can further erode returns, making this a riskier bet than owning gold directly. If you enjoyed this deep dive into the economics of gold, please like, subscribe, and hit the notification bell for more insights from Economic Briefing. Thanks for watching.